2026 would be a year of lower oil prices and crude oversupply. Producers reshaping strategies to cope with oil revenue loss. Author K. Ravindran. As 2026 approaches, the global oil market is heading into a year that could decisively reshape price dynamics, fiscal planning in producing states, and energy security calculations for importing economies. The defining feature of the coming year is not demand destruction or geopolitical shock, but the growing weight of surplus supply. Market projections suggest that oil could face its largest oversupply in years, with as much as 3.2 million barrels per day potentially returning to the market if OPEC Plus chooses to unwind its voluntary production cuts. This looming excess sets the stage for a year of difficult trade-offs, strategic recalibration, and shifting leverage between producers and consumers. The supply-side arithmetic is stark. Voluntary cuts introduced by OPEC Plus were designed to stabilize prices in a market struggling to absorb uneven post-pandemic demand growth, accelerating energy transition policies, and efficiency gains. These curbs have so far prevented a deeper price slide, but they have also stored up a dilemma. Should the alliance decide that defending market share is more important than propping up prices, a significant volume of crude could quickly re-enter global trade flows. Even a partial unwind would tilt balances firmly into surplus, amplifying downward pressure on benchmarks. Demand growth, meanwhile, is proving resilient but insufficient to absorb the additional barrels. Consumption is rising steadily in Asia, led by petrochemicals, transport fuels, and aviation, yet the pace is no longer explosive. Structural factors such as electrification of transport, fuel efficiency standards, and slower economic expansion in developed markets continue to cap upside potential. Against this backdrop, even strong buying by China may not be enough to tighten balances. China has been rapidly building its strategic crude inventories, taking advantage of price dips to add to state reserves. This policy-driven demand provides a temporary cushion, but it does not fundamentally alter the global supply-demand equation. Strategic stockpiling is finite and opportunistic. It cannot indefinitely offset millions of barrels per day of new supply. For OPEC+, 2026 could therefore become a year defined by difficult choices rather than decisive control. Extending production cuts would support prices but deepen internal strains within the alliance, particularly for members eager to monetize capacity investments or facing fiscal pressures. Accepting weaker prices, on the other hand, risks eroding government revenues and testing domestic budgets, even if it helps preserve market share and discourage rival production growth elsewhere. The political economy of this decision is complex. All exporting states rely heavily on hydrocarbon income to fund social spending, infrastructure projects, and economic diversification plans. Prolonged price weakness would force uncomfortable adjustments, from higher borrowing to spending restraint. Anticipating this risk, key OPEC Plus producers have been quietly reshaping their strategies. One of the most significant shifts has been the aggressive expansion of refinery capacity and downstream integration. Rather than relying solely on crude exports, major producers are investing billions of dollars to convert more of their oil into higher-value products such as fuels, petrochemicals, and specialty chemicals. This move reflects a pragmatic recognition that refining margins and downstream revenues can help offset volatility in crude prices. It also signals a broader attempt to capture more value across the supply chain, insulating national oil companies and state finances from pure upstream exposure. New and expanded refineries across the Middle East and parts of Eurasia are designed not only to meet domestic demand, but also to serve export markets in Asia and Africa. These facilities are increasingly complex, capable of processing heavier crudes and producing cleaner fuels that meet tightening environmental standards. For producing countries, the logic is compelling. Even if crude prices soften, refined product exports can generate steadier cash flows and reinforce long-term trade relationships. Over time, this downstream push could subtly alter global trade patterns, with more refined products competing in markets traditionally supplied by independent refiners. Yet this strategy also carries risks. A surge in global refining capacity raises the possibility of margin compression if product markets become oversupplied. If multiple producers pursue the same downstream hedge simultaneously, the result could be intensified competition and lower profitability. In effect, the volatility may shift from crude prices to refining margins, redistributing rather than eliminating risk. Still, from the perspective of oil-dependent economies, diversification within the hydrocarbon value chain is preferable to remaining exposed to a single, increasingly uncertain revenue stream. For importing countries, the outlook is more straightforward and largely favorable. Nations that rely heavily on imported crude stand to benefit from the prospect of softer prices through 2026. Lower oil prices reduce import bills, ease inflationary pressures, and provide governments with greater fiscal space. For a country like India, which imports the majority of its crude requirements, the implications are significant. Cheaper oil translates into lower energy costs across the economy, from transport and manufacturing to fertilizers and power generation. This can support growth, improve the trade balance, and give policymakers more room to manage subsidies and taxation. India's energy strategy is already shaped by a keen awareness of oil price cycles. The prospect of further price declines in the coming months offers an opportunity to build strategic reserves, renegotiate supply contracts, and diversify sources without the pressure of elevated costs. It also provides a buffer against external shocks, allowing authorities to smooth domestic fuel prices and contain inflation. For consumers and businesses alike, sustained moderation in oil prices would act as a quiet stimulus, boosting disposable incomes and competitiveness. Beyond India, many emerging economies share similar incentives. Import-dependent nations across Asia, Africa, and parts of Europe could see tangible gains if the projected oversupply materializes. Airlines, shipping companies, and energy-intensive industries would all benefit from lower input costs, potentially spurring investment and expansion. At a macro level, reduced energy inflation could allow central banks greater flexibility in monetary policy, particularly in economies still balancing growth with price stability.